A very good afternoon to all my dear students. This is Professor Shaurya Shah welcoming you all to the lecture of SY BBA Semester 3. Subject is Financial Management. I hope students, each and everyone is doing great. Dear students, in the last lecture of Financial Management, we studied various methods of capital budgeting that included profitability index. We also saw net present value method. In the previous lectures, we studied ARR method, that is accounting rate of return, in detail. We also studied around 4 methods, and today we are going to start with another new method that is known as again payback method, right? So in all students, you have 6 methods in your chapter. We have completed 4 methods in detail with merits and demerits and example for that. Today we'll be starting with another method, again an important method from your examination point of view, that is payback period method. Fine. So what is the method all about, dear students? First of all, the name itself says payback period method, right? So we are calculating the investment amount which we have invested and into how many years we will be getting back those amount, or how many time period we will be paid back with that amount. That is why the name itself suggests payback period method, right? So into how much time period your capital invested will be paid back, that you are calculating. So what is the method all about, students? This method tells us as to within how many years we will be getting back our original investment in the form of net cash flow from the project. Now in the previous methods also we have studied, students, that net cash flow, right? So net cash flow, what is it? Every year you are getting certain amount of income, certain amount of cash flow from your project. So in form of net cash flow, how much years or how much time period it will take to get me back my investment. Fine. So what is it? The period during which the promoter of the project is going to get back his investment in form of net cash flow is also known as payback period, right? So in simple terms, whatever I am investing, into how many time period I will get it back, that shows me my payback period. Fine. For example, for your understanding, just read it. If the investment of rupees 10 crore is likely to be received, today I am investing 10 crore rupees in a project. I will receive it, students, in 7 years. Then my payback period is 7 years. As simple as that. 10 crore rupees at a time, at a moment I will not receive it. Suppose for the first year I receive 1 crore out of it. Second year the project has started, so I receive 3 crore, then 4 crore, then 5 crore. So what is it? It is total net cash flow, and if I total it into how many years I am receiving back my 10 crore rupees, that shows me my payback period. I suppose it is clear to everyone. This method is very simple to understand and easy to calculate. Fine. Moving on, how you will calculate this method, right? In every method we have understood the concept of the method, their merits, demerits, and how the calculation is done for actual sum, right? So here also we will see each project is ranked on the basis of payback period, right? Now just understand, students, in practical world you are not having a single project in your hand. You will be considering various alternatives. From that alternatives, each project is ranked on the basis of payback period. For example, if a project's payback period, we will calculate right now only, but if we calculate one project's payback period is around 5 years, in 5 years you are getting back your money. In second project you are getting back your money in 7 years. In third project you are getting back your money in fourth year, right? So what is the rank which we will give? First, the project getting back money in 4 years will come rank 1, then with 5 years rank 2, and then with 7 years rank 3. So what we'll do, each project is ranked on the basis of payback period. The shortest period project is ranked as number 1, as we did 4 years. Longer than that is given number 2, 5 years, and so on, that is 7 years. I suppose everyone is clear with that part. Fine. Now project within the shortest payback period is selected. So definitely if I am investing the money, I will invest in that project which gives me the earliest return out of it, right? So that is my payback period. How it is calculated, dear students? For projects with fixed income. Now fixed income, I can say, give you an example. Suppose I am investing 5 lakh rupees in a project. So every year, if I am getting 1 lakh rupees of cash flow, it is fixed. So within 5 years, I will receive back my investment which I have made, right? So that is fixed. Second is your fluctuating cash flow. Suppose first year I am receiving 50,000 rupees. Second year I am receiving 1 lakh rupees. Third year I am receiving 2 lakh rupees. Fourth year again 50,000. And fifth year again 1 lakh. So my cash flow is not fixed, but it is fluctuating. So you need to calculate payback period under both the methods, under fixed cash flow also and under your fluctuating cash flow also. Fine. So we will see the basic formula for fixed income cash flow is your net investment divided by yearly net cash flow, right? How much yearly, as I gave you example that for 5 lakh rupees of net investment I am getting 1 lakh rupees of net cash flow every year. So what I'll do is 5 lakh divided by 1 lakh gives me the payback period of 5 years. Is it clear? You will be much clear with this example. The same thing which I told you, estimated investment in a project is 50 lakh. Just add 10 in the example which I gave you. And the annual net cash flow is 10 lakh. So find out the payback period. It is very easy, students. Net investment upon yearly net cash flow. So very simple it is. 50 lakh divided by 10 lakh is 5 years. So at the end of 5th year, we will get back the investment which we have made. So what is the payback period? It is 5 years. I suppose it is clear, everyone? Fine. Now moving on to the next part of the method, that is your fluctuating annual cash flow. As I told you, what is fluctuating annual cash flow? If you can see in the example, the net cash flow is continuously fluctuating. It is not fixed. In the very first year you are getting 1 lakh, second year you are getting 3 lakh, third year you are getting 6 lakh, and fourth year you are getting 10 lakh. So what you will do, out of 8 years, right, you have been given 8 years and a cash flow for continuous 8 years. What you need to do, you need to again find out the cumulative cash flow. Remember students, two methods in payback. First, what we did was your fixed income. Second, what we are calculating is your fluctuating cash flow. Fine. So if it is a fluctuating cash flow, what you need to do is you need to find out the cumulative cash flow. What do you mean by cumulative cash flow? For example, year 1, I am getting 1 lakh rupees of cash flow. So my cumulative will also remain 1 lakh only. Second year, I am getting 3 lakh rupees of net cash flow, students, right? So if I am getting 3 lakh, so in 2 years in total, how much I have got? 1 lakh plus 3 lakh, that is 4 lakh rupees. Cumulative, total plus the next one, total plus next one, total plus next one, right? So what I'll do is, for first year it will remain the same. For the second year, 1 lakh plus 3 lakh gives me 4 lakh. For the third year, 4 lakh plus 6 lakh gives me 10 lakh. For the fifth year, again 10 lakh plus 10 lakh gives me 20,000. 20 lakh, sorry. 20 lakh plus 15 lakh gives me 35 lakh. So on and so forth, I'll calculate till the last, that is 59 lakh plus 10 lakh gives me 69 lakh, right? So what we are doing is we are finding out the cumulative cash flow, students. Now this shows, cumulative means the total cash flow every year, so that I can find out in which year I am getting my investment back. Fine. So if we again quickly move on to the sum, right, that is the example which is given. So we will find out that the total estimated annual cash flow, right, so that is my investment of 50 lakh rupees. The sum remains the same, students. What is my investment? Estimated investment in a project is 50 lakh. So here when it was fixed, we were very easy to find out 5 years, right? But here 50 lakh you need to find out in which year you are getting back, right? So again, first year, second year, third, fourth, move on. Sixth year you are getting 47 lakh, students. And seventh year you are getting 59 lakh. Now here you need to find out the fraction of the exact time period in which year, which month you are getting the amount, right? So what we will do is, in sixth year, at the end of sixth year, you are getting 47 lakh. So how much balance? I invested my 50 lakh rupees, right? So at the end of sixth year, you are getting 47 lakh. We invested 50 lakh rupees. So what is the difference which we need to recover? That is 3 lakh. I hope it is clear. 50 lakh minus 47 lakh gives you 3 lakh rupees difference. Now this 3 lakh I need to recover from the next year, that is 7th year. But in 7th year, dear students, if you can see, the cash flow is 12 lakh rupees. So for entire year I am receiving 12 lakh rupees. So in how many months I will receive my 3 lakh rupees, right? So you can see if 12 lakh is received in 12 months, into how many months 3 lakh will be received. So I will get the answer of 3 months. Fine. So what will be my payback period? Complete 6 years plus 3 months of getting my 3 lakh rupees. So my payback period will be 6 years 3 months. I hope everyone is clear with that part. Fine. So what is it all about? It is your payback period. Now when it is, again repeating, when it is your fixed period, it will remain the same fixed cash flow. It will remain the same net investment divided by total net annual cash flow. When it is fluctuating, you need to first write down, dear students, the year. Then you need to write down cash flow of each year. Then you need to again do the cumulative cash flow, CCF. Add up every cash flow in the previous year's total cash flow and then find out in which year you are getting back the investment. For example, for a change in the sum, if we had invested 59 lakhs in total project, so my answer, if you see, will change to exact 7 years because I am getting 59 lakh rupees back at the end of the 7th year. I suppose each and everyone is clear with the part. Fine. Just go through the points once again. How we have found out. You need to remember this formula because complete year is taken. That is 6th year, and after that you need to calculate the proportion of month. Simple example stands for if we are getting 12 months so much amount, how many months we will be getting the difference amount. If total investment in 12 months, that is total cash flow in 12 months, how much we will get? The difference amount of the cash flow. Is it clear? Fine. Just go through the sum once again, students. Total investment was 50 lakh. We were being given years and the cash flow, and then we calculated cumulative cash flows. And the answer is your 6 years, 3 months. Each and every sum will be asked in your university, so you need to be very clear with the formulas part because in university many methods will be asked together. The sum will be solving, right? So that you can get much more clear with the practical sums. Moving on to the merits of the method, right? What are the merits of your payback period method? Amongst that is the very first, this method is very simple to understand and easy to calculate, right? As we saw, you just have to calculate the cash flows. You just need to check in which year you are paid back with your capital. So this method is very simple to understand and easy to calculate compared to other methods. The second is gives importance to the risk factor. How it gives importance to the risk factor? It gives importance by selecting the project with the shortest payback period, right? So more the life of the project, more are the chances of the risk. So what does it do? It selects the projects with the shortest life period so that the risk factor is minimized. The third is it considers liquidity also at the time of making the investment, right? How it considers the liquidity at the time of making the investment? It considers the annual cash flow, as we saw. After 1 year, how much you are getting, after 2 years, how much you are getting. So it starts liquidity calculation even after the project is implemented, right? So again, it considers liquidity position. The next is before technology becomes obsolete, it tries to recover back the investment, right? Continuously you are knowing in the fast changing technology period, before the technology becomes obsolete, it is very much necessary to receive back your investment because once you have installed the project, it is in lakhs and crores of rupees, students, right? So once the technology is outdated, your entire project is gone and your money becomes zero. So before it becomes obsolete, it tries to recover back the investment. How? It selects the project with the shortest time period. Next is, dear students, prefers project yielding fast returns, right? How it prefers project yielding fast returns? Because the shortest time period is selected. So shortest time period itself means the project which gives you maximum cash flows in the shortest time period. So project yielding fast returns. Next is, this method saves time, energy, cost and money, right? How? Because it is simple to calculate and easy to understand. Again, the project analyst can calculate on the basis of estimated cash flows and the number of years. So it saves time, energy and cost and money. Next is it is free from prejudice of size of investment, right? Irrespective of size of investment, students, project with the shortest payback period is selected, right? Whether your investment is more or less, the equation will remain the same. You are selecting the project on the basis of shortest time period. I suppose each and everyone is clear with this part. Fine. To go through with the merits of it, 7 points. The very first is simple to understand and calculate. Next is gives importance to the risk factor. Third, it considers liquidity also. Fourth, before the technology becomes obsolete, they are selected. Project is again giving back your return. Next is it prefers project yielding fast returns. Next is it methods saves time, energy and cost and money. Next is it is free from prejudice of size of investment. I suppose it is clear to every student. Fine. Moving on to the demerits of payback period method. As every coin has two sides, this method is also not free from limitations. The very first limitation is it does not take into account the cash flow after payback period, right? It does not take into account the cash flow after payback period. Just now only we saw in the sum, right, that we are receiving back the money between 6th year and 7th year. So what was our answer? 6 years and 3 months. So after the 6 years and 3 months, whatever amount we are receiving, that is 10 lakh plus the 9 lakh of this. So 19 lakh we are receiving after the payback period. So what about that, students? So this method does not consider that cash flow also. Maybe it is possible that in the projects with longer time period, after the completion of your payback period, you may receive higher returns, but this is not considered in this method, so it is a limitation. Fine. So it does not take into account cash flow after payback period. The next is it does not evaluate on the basis of profitability, as rate of return is not counted. Definitely, the rate of return is not counted here. We are just considering the time period. How much profitability we are receiving on the investment which we have made is not calculated. The next is it does not considers the time value of money. In every method of previous lecture, net present value and every method, we saw the time value of money. We are receiving in 6 years, 7 years or 8 years, but what is the value of that money? We are just calculating the investment. Suppose in the last example we saw, students, that 50 lakh rupees we are receiving in 6 years 3 months, but is 50 lakh value the same today and after 6 years 3 months? No. So this method fails to show the time value of money. Next is it is not consistent with the wealth maximization objective. Dear students, as it is not considering the basis of profitability, it is not showing the actual wealth maximization. It is just showing us in how much time period we are receiving back our investment. So this method again fails to give us the wealth maximization objective. The next is differences in cash flow of different projects in different year is important for decision making. Dear students, when we are calculating various alternatives, it is not necessary that different projects may have the same cash flow, right? And again in the same years, many a times it happens that one project is giving lesser cash flow in the earlier years and it is giving more cash flow in the previous years, and that is your next coming years. Many projects it happens that it gives very high return in the shorter period and it gives lesser return in the longer time period. So how can you calculate the differences between both the projects? So this method fails there. Next is economic life of a project is not considered. Dear students, we saw economic life. What is economic life? It is the total life of the project during which it gives you the cash flow. So in this method, economic life is not considered. Why? Because we are seeing only the project which gives in shorter time period. I suppose it is clear to every student. And the next is it gives importance to the time period and ignores the cost of capital. In last previous two methods, we saw the discounting factor, that is your cash flow factor, right? So in this method, it never shows the cash flow because the discounting factor is not considered. I suppose it is clear to every student. Fine. Now the next thing is demerits we have completed. Now one sum we will be solving for your payback period method. Fine. This sum again will be continuing with all the other methods also, so that your every method is clarified. Fine. I suppose everyone is clear with the calculation part of payback period method, how to calculate it, their merits and their demerits. Fine. Starting with the sum, students. What is the sum all about? A company is considering investment proposal to install a new machine. What is the main objective? Objective is to install a new machine. The machine will cost rupees 40,000 and the expenses for installation are rupees 10,000. So first of all, in payback period method, we need to know the total investment that we'll see. The life expectation of the machine is 5 years and no salvage value. That is your no scrap value at the end of 5 years. So what is the life of the machine? 5 years. What is the investment? 40,000 plus 10,000. The company's tax rate is 55%. The firm uses SLM for depreciation. SLM, dear students, straight line method, the depreciation remains same every year. So the estimated CFBT, that is cash flow before tax, from the proposed investment proposals are as follows, right? Cash flow before tax is the CFBT. Fine. I suppose it is clear to every student. Fine. Now the next thing, with the question, if you are clear, will be start with the payback period. So what has been asked, students? You need to compute the payback period for the given sum. So we'll be starting with the sum. Before starting, you need to do some calculations that we will be continuing. Fine. So you can note down the sum if you want very quickly. Just the cash flow before tax. You need to note down along with the years. I'll give you 10 seconds if you can quickly note down the sum, so that it will be easy for you to calculate the things. Okay, fine, students. We'll be beginning with the sum. What is the very first thing you need to know is to find out the total investment. What is the total investment? Is your cost of machine, that is 40,000 plus installation cost, right? You must be knowing the concept of cost also. We add up the cost of machinery or the asset plus any of the capital expenditure which you have made. So 40,000 plus 10,000, my total investment is 50,000. So my eyes should search in the entire cash flow in which year we are getting 50,000 rupees back, because it is, if you had seen in the sum, it is not the fixed cash flow method, it is your fluctuating. So we need to do lots of calculation. Fine. So first and the foremost thing is to find out the total investment. 40 plus 10 is 50,000, right? Now important thing to be noted in your exams also is, for working out payback period, cash flow after tax but before depreciation is considered, right? Understand the term very carefully, students. Cash flow after tax but before depreciation is considered. So if you understand, CBFT is your cash flow before tax. Fine. So what we'll do is, we'll prepare an entire column table of 8 columns. What is the column all about? First understand, then you can note it down. In the first column, you need to write down the years. What is the economic life? That is 5 years you are having the machine's life. Fine. So 5 years you will write down. CFBT is what is given in the question. 10,000, 11,000, 14,000, 15,000 and 25,000. This is which is already given in the question that I have written. The next thing is after depreciation. So first I need to find out the amount of depreciation. You all must be very much expert in finding out the depreciation. How you can find out? It is a SLM method, students. So it will remain same every year. So what is the formula of SLM? It is cost minus scrap value divided by number of years of the asset. So here cost we are having 40 plus 10, 50,000 minus no salvage value, so 0, divided by 5 years of the life. So 50,000 divided by 5 is 10,000. So every year I will be charging the depreciation of 10,000. So in the first column years, second column CFBT, third column depreciation. Fourth column, you need to deduct depreciation from CFBT. So 10,000 minus 10,000 gives me 0 rupees. 11,000 minus 10,000 gives me 1,000 rupees. 14,000 minus 10,000 gives me 4,000. 15,000 minus 10,000 gives me 5,000. 25,000 minus 10,000 gives me 15,000. I suppose it is clear to every student. So first here, then CFBT, then you need to calculate the depreciation. If it is as per WDV, then you need to find out as per WDV and then you have to deduct it. As SLM is given, we have found out SLM. WDV is your written down value, reducing balance method. So fourth column, I suppose everyone must have got it. Next is you need to deduct tax, students, right? So tax, always it is a logic that depreciation benefit is achieved. That's why we deduct the depreciation first, then we provide the taxation. So what I'll do is, corporate tax rate is given in the question, that is 55%, as you have seen. So what I'll do is I will deduct 55% from this column. So 0 into 55% is 0. 1000 into 55% is 550. 4000 into 55% is 2200. So on and so forth. So my fifth column will be the tax rate. Right? I have calculated. Now the next is cash flow after tax, that is CFAT. This was CFBT. So cash flow after tax, that is this column minus this column. So 0 minus 0 is 0. 1000 minus 550 gives me 450. 4000 minus 2200 gives me 1800. 5000 minus 2750 gives me 2250. 15,000 minus 8250 gives me 6750, right? So what I have done is, students, first column again repeating years, then CFBT given in the question, then depreciation, deduct depreciation from that, that is CF after depreciation. In that, calculate the tax, you can deduct the tax in it, you will get CFAT. Do the total of this CFAT, that is cash flow after tax, right? Again, the next thing is, again add the depreciation. As I told you in the previous slide only, you need to calculate cash flow after tax. That is cash flow after tax, but before depreciation. So first, remember, we will deduct the depreciation, then we will add the depreciation. The final column you need is cash flow before the depreciation. So 10,000, you need to do it, right? 10,000, 10,000, 0 plus 10 is 10,000. 450 plus 10,000 is 10450. 1800 plus 10,000 gives me 11,800. So on and so far, you will calculate the column. I suppose it is clear, every student. So payback period will be counted from this column, dear students, right? Again, so what is my investment total? My investment is 50,000 rupees. So I need to find out in which year I will receive my 50,000 rupees back, right? So same we did in the last sum, that is fluctuating method. So we need to find out the estimated cumulative cash flows. So how we will find out the estimated cumulative cash flows? You need to again write down the years. The cash flow, that is your cash flow before depreciation. In that cash flow before depreciation, you need to do the cumulative. So first year is my 10,000, remains the same. Second year, 10,000 plus 10450 gives me 20,450. Third year is my 11,800, gives me 32,250. Plus 12250 gives me 44500. 44500 plus 16750 gives me 61250. So I suppose you must have found out the cumulative cash flows also. Fine. Now from this, students, you need to find out in which year you are getting back the total investment. What is my total investment? 50,000. So if you see in the above years, in the year fourth, I am receiving 44500, that is closer to 50,000. In the fifth year, I am receiving 61250. So what will be my answer? My answer will be between fourth and fifth year. But what exact, that we need to find out, right? But before finding that thing, I'll give you time to note this down, right? Very quickly, 12 seconds to note down this table if you have not yet noted it down. Okay students, so I suppose everyone must have written this table and this cumulative cash flow also. So we'll be calculating. As you can see, total investment is 50,000. Total receipt at the end of the fourth year is 44500. So what I need to do is same procedure. Total investment 50,000, receipt is 44500. So what is the balance which I need to carry forward, which I need to recover from the fifth year? 50,000 minus 44500. So 5500 I need to recover from the fifth year. Now what is the cash flow, dear students, of the fifth year? It is 16750. So if in 12 months I am receiving 16750, in how many time period I will receive 5500? So the answer is 4 months, right? So in total time period, if I say in how many months or years I will receive my 50,000, I will receive it in 4 years and 4 months. Therefore, payback period is 4 years and 4 months. I suppose it is clear to every student. Fine. So first of all, you need to calculate the various costs. Once you get the total investment, you need to find out the CFBT given in the question. Then you need to find out the depreciation, deduct the depreciation. Then you need to find out the tax rate. After tax rate, you calculate the again add up depreciation in that CFAT. Then you find out the cash flow before depreciation. This will be helpful to you to calculate this table. I suppose every student is clear with this part. Fine. So again, next lecture, dear students, we will be calculating on the same sum. The same sum we will be following. So keep your sum ready. What we'll do is, we have calculated one method, that is your payback period method. In the next lecture, we will find out ARR also on the same sum. We'll be finding out the net present value also on the same sum, and we'll be finding out the profitability index also. So revise all the methods, whatever we have done in the previous 2 lectures, we'll be implementing in the same sum. Then we'll be continuing with the next method, that is your IRR, and it is the last method of your unit that you need to do. Then we'll be continuing with the practical sums, right? So what you need to do is, you need to again write down a list of formulas for every method, solve the sums whatever we have done in the lecture, and then we'll be moving on further, right? So I suppose everyone is clear with today's part, students. So far we have completed most part of your chapter, that is long-term decisions of investments. We have seen capital budgeting, its various methods, advantages, limitations, how to solve the sums, and then if any doubts, you can surely put up in your Google Classroom. I am here to solve your doubts. Fine. So again, I hope that all of you are clear with today's part. Fine. So we'll see you in the next lecture very soon. This is Professor Shaurya Shah teaching you Financial Management SY BBA Semester 3. Thank you everyone for your attention. Take care. Have a good day ahead.